Hi, good afternoon, and welcome back to the Tom Morgan Show. Today I'm joined by Tim Sunderland, a stockbroker, trader, investor, and founder of Mitto Markets. Mitto Markets is a London-based brokerage where Tim and his team will be on call and ready to help you with all of your trading and investment needs. Today we're going to be talking about some finance fundamentals. We'll be doing a deep dive on certain asset classes. We'll be lifting the lid on Mitto Markets, and indeed we'll be talking about the man himself. So, without further ado, Tim, welcome.
Thank you. Cheers. First things first, your capital is at risk. We'll take your house, your kids, the lot. So just to get the compliance happy, your capital is at risk. Anytime you mention midterm markets, I've got to get that in there.
Yeah, full disclosure.
Yeah, absolutely. But yeah, thank you for having me on. I'm absolutely thrilled and I'm absolutely flattered that you consider me. So yeah, no, kudos to yourself for asking me to do this. Thank you.
No, no, of course, it's. Thank you for coming on. It's my pleasure, and I
Oh,
really do
cheers.
appreciate your time, Tim. You mentioned before we started that you may get a couple of calls during this episode. I think you said you had one call potentially coming in where you're going to have somebody with
Mm,
buy a load of sell orders, was it? Can you, without
yeah,
giving us specifics, can you tell us a little bit about that? Sounds
yeah.
interesting.
So most people, we're sort of hybrid. So we have a platform where you can trade on, and that's wonderful, and it's full of all the gadgets. Some people just don't want to muck around with that and go, just Tim, over the phone, can you sell my stocks? And then so it's quite rare, but sometimes clients just prefer to just know that I haven't pressed the wrong button, I haven't fudged it up. And I've got a close friend. He's over in Thailand. He's building a house over there, and the building costs are just sort of running out of control. So every few weeks, I get a call saying, "Can you sell a few more stocks?" Which is a bit. This is really common, actually, with high net worth individuals of the sort of older age. They'll start out with a portfolio and they build it up nicely, and this happens so many times. It's always the same case. Tim, I've seen a property I want to buy, or I'm going to build a property, so I need to sell down my stocks. Because you should always have at least 5 year time horizon, and inevitably what happens 2, 3, 4 years into it, go, I'm going to buy a property, so I need to sell my stocks, which is a shame, but it is what it is. And that's what he's doing. So he's buying well, no, he's not buying, he's building a little house in Thailand, which sounds absolutely delightful. So I
Yeah, yeah.
think money better well spent over there, if I'm honest with you. So at some point you have to enjoy your money.
Absolutely. Well, absolutely. Yeah. So he's going to realize some profits when you said sell, I wasn't sure if that meant like a sell order, as in a short position
No,
you
no,
wanted
he's
to
just
place. That's
liquidating
actually
positions. Yeah,
liquidating.
yeah. So
All right.
he's got like a barbell approach. He's got US growth stocks, which are all in profit, like your sort of your Palantirs, your Apples, your Microsoft, your Airbnbs. They're all doing well. And then he's got an income portion of the portfolio, just investment trusts like your common names like Merchants Trust, City of London, that sort of stuff. And I think he's just going to crystallise a small loss on those because I think he sees more potential in the capital appreciation on the growth stuff. But that's just his opinion. So, um,
Sure.
and I think where we've got Jerome Powell speaking later, if he gives any hint that we might be in for a rate cut, then he may as well just hold off for a few days and see if the market pops up a bit on anything that the Federal Reserve say. So fingers crossed he comes out and said, yeah, we're cutting interest rates by 300 basis points and the market doubles, but I doubt it.
Where will you be watching that, Tim, on Bloomberg, or is that on your terminal? Or
I'll just watch it on the business channels. I'll flit it in and out. I try not to stay too macro obsessed because it can kind of cloud your vision.
yep,
And whatever the market does, the market will do.
macro obsessed.
Yeah, exactly. Yeah, and just sort of concentrating too much on the sort of the day to day economic figures because it can just really cloud your judgment. And I just it's personal really. I prefer to just take more of a bottom up, company specific business approach, and I invest in
Mm.
companies that I like. I don't get obsessed with the share price movement. I just concentrate more on the business. If the business is doing well, 9 times out of 10, the share price will follow it. And sometimes when you get too obsessed with the macro stuff, you can convince yourself out of a great trade or a great
Yeah.
investment.
Okay.
And rule of thumb, the less you look at the market, the better you'll do. Generally speaking, which sounds
Right.
intuitive, but it's like a bar of soap. The more you touch it, the smaller it gets. Just sometimes it's best just to leave it alone.
Okay. I like that bar of soap. I like that. So it's very much a bottom up approach, like, kind of like an old school Warren Buffett approach
Yeah.
to the way you go about picking your stocks, picking your positions. Interesting. So before we get too into it, Tim, I do like to start these episodes with giving the guests an opportunity to introduce themselves. So give us your background and lead us up to where you are today. So Mitter Markets, how you founded it, and why you founded it, and yeah, where it is today. That would be great.
Yeah, I mean, I suppose this wasn't really something I ever envisioned or wanted to do. I always thought setting up a brokerage would be sort of well beyond my own skill set, and maybe it is. I'm still in the and it was thrust upon me. So I've been a stockbroker for sort of, I don't know, 12 plus years, something in that region. I don't come from any kind of academic background. I left school at 15. I was just useless at school. I didn't like it from start to finish. And I suppose I was just floating around doing retail jobs, working in Devitt Smiths, doing this, doing that. I was washing cars, all sorts. And then one day I was just flicking through Sky, stumbled upon the business channels like Bloomberg, CNBC, and I just found the whole thing so exciting. The flashing lights, the US commentary, and I was just hooked straight away. And it just became a bit of a hobby, an obsession. I was just glued to these business channels, and I was thinking, what do these guys know? How are these guys predicting, the price of an asset going up and down? And it all just stemmed from there. Started at one of these kind of, I'd say, awful firms. 400 phone calls a day. I won't mention the name. They're a sort of boutique firm, let's just say that, but not very good. And you start out. I think the salary on my first job was £12,500 a year. So you're living on nothing, and you're working from 8 a.m. till 8 p.m. And I'm not exaggerating when I say 400 phone calls a day, and it was just horrific. I mean, you'd have banks of desks. You'd have about 3 or 4 banks as desks, 4 guys on each bank, 1, 2, 3, 4, and then every week 1 or 2 guys would be fired. So you've got this sort of
wow,
this bottom sort of shredder at the bottom, and I had this thing. I just wouldn't let my receiver down for more than a nanosecond, because that's how they'd fire you. They'd give you a call on the internal phone and say, "Tim, would you come into the office?" And I was so paranoid.
No.
The receiver down for more than a split second, and they could never get through to me.
So they could never get through to you. Yeah, they'd have to actually come and see you.
Yeah,
Not going to happen.
It did, because I had so much outbound calls. I wasn't the best on the phone, but I was the hardest working, and I was able to keep my head above water and sort of, I suppose, what's the expression? Cut your teeth, I suppose.
Yeah.
For a while, went for a few different jobs, kind of still in this sort of second league of brokerage, I suppose you could say. We're not talking Goldman Sachs or Morgan Stanley, we're talking sort of more crappy firms. And then
Tier 2 firms, perhaps.
Yeah, tier 6 or 8, if you like. Yeah, yeah, not great. And then after a while, did actually make my way up to some sort of quite good, reputable firms, and I was let go from one of them, and it was just going into lockdown, and they closed. So I went to get another job. They then insisted that I sit out my non-compete clause for 6 months, so I couldn't actually get another job, and there we are. So after a few months, I thought, do you know what, I can't be tied to these non-compete clauses. I kind of want to do things on my own terms. I want to flex my creative muscles a bit, whether it's just promoting the business on Instagram or TikTok or YouTube. And I just wanted freedom. I just wanted to work for myself. It wasn't to build a multi-billion-dollar company. I just wanted to work for myself. And then August 2020, I launched Mitter Markets, and it's been wonderful. It's been challenging. It's been terrible at times. But we're sort of 3.5 years into it, and so far so good. We're still here. We're still going.
Amazing! What an achievement!
Thank you.
What an achievement! I can totally relate to that. The idea of what's led me to where I am today is just that. It's the idea of working for yourself.
Yeah.
And working on your own terms. So yeah, I can completely relate. So, to get into it then, Tim, what I kept coming back to, I was trying to think of how to start this and what questions to ask, and what I kept coming back to time and time again was the word markets.
Yes.
and it's in your business, your brokerage, Mito
Yeah.
Markets. The word
Yes.
markets is in the name of your
Yeah.
business,
Yeah.
and we've probably in talking, no doubt, we've actually used that word a couple of times already. So everything sort of stems back to markets for me.
Mm.
And if we go, if we go way back in the day, where a farmer, for example, would take his or her grain to a
Yeah.
market to trade it.
Yeah.
Fast forward, that's a market. I mean,
Yeah.
fast forward that to today, it's fundamentally, I don't think it's really changed, has it? I mean, it's gotten more complex, as in there's more markets than ever before. There's more instruments in between
Yeah.
the buyer and the seller than ever before. But fundamentally speaking, is it not the same thing?
Pretty much, yeah, pretty much, and kind of what you're describing there is the oldest original version of what a futures contract as we know it today. And futures contracts are traded in the millions of contracts every day, whether it's gold, coffee, pork belly, butter. Even sometimes we get people trading butter futures on our platform. It's still from that original concept of a farmer locking in a price for the grain he is yet to grow and making sure he can secure that cash flow. Yeah, over the years it's got more complex. There's more derivatives. There's more contracts. But yeah, in essence, yeah, you're absolutely on the money with that one.
Yeah.
About say
Because
even
a future in its own right would, sorry, a future in its own right would be a form of a derivative,
yeah,
would it not?
yeah,
If
yeah,
it's
yeah.
deriving its value from something else.
Exactly, yeah. A highly leveraged derivative. And even if you think back to, say, the London Stock Exchange, the origins of the London Stock Exchange, that started at a place called Jonathan's Coffee House, and if I'm not mistaken, on Change Alley, which used to be Exchange Alley, where you'd have a group of chaps all gathered in a circle around Jonathan's Coffee House, buying and selling various assets until one day it became a formalised. I think the coffee, if I'm not mistaken, the coffee shop owner just brought them in and said, right, just trade in here and I'll charge you some money. And that was the origin
No,
of the London Stock Exchange. Yeah, yeah,
that's amazing.
yeah.
That's amazing. Which,
Coffee house. Yeah,
which, so I mean, we look at the London Stock Exchange today, which is this big, gigantic, international, daunting
yes,
entity.
yeah,
But it goes back to a few people trading in a coffee house,
yeah,
which again it is the same thing as any marketplace.
yeah.
So
And you
if
just create
if
all the
you
formalities, and before you know it, you've got all the nuances and the intricacies and all these rules and exchange rules that have been developed slowly over many decades, and there we have it. Yeah, it comes from simple humble beginnings.
amazing, that's incredible. So and we can talk asset classes and
Yeah.
instruments all day long, but going back to markets, like you've got to name a couple of markets, you've got stock markets, you've got commodities markets, you've got bond markets. I guess you could say derivatives are there's a derivatives market. I mean, I
Yeah.
guess you'd probably unpack that a little more and call it a futures market, or would you call it a CFD market? Would that be
Yeah,
an example
yeah,
of a market?
good. Yeah, yeah, absolutely. I mean
Yeah.
the I mean it must be in the tens of thousands of sort of types of markets and derivatives of markets there are. It's almost endless because you look at just say one popular stock. Let's say Microsoft. Microsoft will have an options market where you can buy an option to buy someone else's stock off them and pay a little premium, and you now have a contract in place that says if your stock is at a certain price by a certain date, I have the right and the obligation to buy it. And that is just one market. And then there's probably hundreds of variations of that one contract. And then you've got CFDs. Then you've got just direct stock borrow, short selling. It's literally endless.
So that would be an options market, but for a very specific company.
Yeah,
That
exactly. Yeah, yeah, precisely.
that's amazing. So in that example, then um, you'd have a Microsoft share or a Microsoft stock, which in
Yeah,
its own right, by the way, is you alluded to it earlier as actually having an ownership stake in that company.
yeah,
But
yeah,
even then, that is just a contract.
yeah,
It's not
yeah,
act, yeah. But then in between that, you've then got another contract,
yeah,
which is an option to
yeah,
buy that. So you
exactly. I suppose the easiest way I can describe it, and because I think most people who have got any vague idea about investing can understand property, and you're a property guy. And let's say, for instance, you're living in a nice house in Gloucestershire, currently valued at £500,000, and I'm on the side of I think the land you're on is sought after, and I think in a year's time your house is going to be worth £600,000. I think there's a 20% upside there, and I go to you, right, Tom, I'm going to give you £20,000, and for that, I want the right and the obligation to buy your house off you at any point in the next 12 months for £550,000.
So that's an option. An option's been created, right?
And come 12 months' time, the house is actually worth £600,000. Luckily, I've already bought the option, the obligation to be able to buy your house for 550, and yes, I've
the
paid
right, but not the obligation.
Exactly. So if it tanks, hey, you're on the receiving end of my premium, which is 20 or 25 grand, whatever I gave you. Yes, your house is maybe not worth as much as I thought it would be, but you've got that premium. You've taken that contract from me, hasn't worked out for me, and so forth, and it works both ways. So that's, in the most simplistic terms, it's a directional way of speculating on the price of an asset going either up or down, and you can sort of just literally buy a contract that gives you the right, but not the obligation to buy it at a set price. So yeah, that's just one type, and then you've got sort of futures, and then futures and options, and all sorts.
Yeah, it's it's endless, and it's layered. That's the word I was trying to find earlier. You've got. I keep calling it contracts, because if you lift the lid, all it really is pieces of paper with agreements written on them, or a contract. So you've got contracts upon contracts. Have you seen that film, The Big Short?
Yes.
One of my favourites. But it's I think they call them synthetic CDOs. It's just like a contract upon a contract upon a contract upon a contract, and it's a swaps market, isn't it? It's insurance contracts. So there's a scene in the movie where I think someone says that the actual market for these swaps, or insuring subprime mortgages, which is what the whole crash was all about, or based on what caused the crash and what the film's about. I think it said that the market for insuring mortgages is like 20 times bigger than actual mortgages itself, or something like that. So the example or the scenario you gave there is really interesting, because it's exactly what I do. So a part of what I do, at least. So I actually go out and find land opportunities. So for example, if you've got a piece of land, and not necessarily with a house on it, it could be a field, for example. And I see that, and I think I could probably put 10 houses on that. I could come to you and say, Tim, I want to buy your land. I love your land. I'd like to buy it. I'd like the option, but not the right. I'd set up an option agreement in the exact same way. I'd like the option to buy your land at this price. Let's say it's £500,000. And then what I would do is I'd add value to that land. I've got the option for a year, let's say. So the option, but not to buy, but not the option, but not the obligation to buy. So let's say that's valid for a year. So I've got that now. I've got that contract, and it says I'll pay you $500,000 for the land. So I'll then go and add value.
Yeah.
Exactly. Yeah. I'll then go and try and add value to that land in the form of planning permission. So let's say that land as a field your field in its current state with no planning permission is worth $500,000. If I add planning permission for 10 houses to that could be worth $1 million.
Yeah. Exactly.
So I then realise my option and buy that land for $500,000, give you $500,000. And then I sell it on. It's what we call a back. I could build that, or I could just sell it on to another developer. It's what we call a back to back. And I've realised £500,000, for example. So not too dissimilar. Our worlds are not too dissimilar in that regard. But in terms of writing up these contracts, then Tim, or these creating these derivatives, is it? How does that happen? Do you have to have a license to do that? I mean, as a broker yourself, are you pulling those from somewhere else, or can you and I, for example, just write a contract from a white sheet of paper? How does it work?
Yeah, it all stems from the exchange. It's the exchanges that will provide the framework for people. A bit like Jonathan's Coffee House when the London Stock Exchange started. Jonathan's Coffee House acted as a ring for people to sort of exchange contracts, and then maybe implemented rules and clearing and liquidity. And it will be the exchange that provides that marketplace for everyone to gather around and exchange these contracts. And then you have sort of technology vendors, like for instance, platform
Bloomberg.
providers. Yeah, exactly. Who can then provide sort of a platform for people to sort of formally exchange these contracts. So yes, in essence, it sounds complicated, but it's actually a very simplistic thing to do. I can, within 2 minutes on my trading platform, open up Microsoft and say I'm prepared to buy Microsoft at, I don't know, $450. I want the obligation, or I want the right to buy Microsoft for $450 for the next 12 months, and I'm prepared to pay this premium for it. And then within a second, that is open to the market. It's sat on the New York Stock Exchange. Others can then see that contract and go,
Right.
yeah, I'll take you up on that. Yeah, and it's there and it's open.
So it's as you call it, a framework. There's there's a framework there, but you've essentially put your offer in,
Yeah, exactly.
and that's then gone out to the wider market electronically.
Yeah, exactly, and it sits on what's called an order book, where everyone can see it. So your contract is up there on the order book, and then at a limit price or whatever price you dictate. And then if someone wants to take the other side of that, the trader's matched up. You've got a buyer and seller. They meet each other, and then it's exchanged.
And that would be an example of direct market access.
Yeah, exactly.
Yeah.
Precisely. Yeah.
Whereas another option could be you're doing that deal with a broker direct, as opposed to direct to the market. So they're taking the other side of your order.
Yeah, exactly. So there's a few different ways a trade, the mechanism of the trade goes through. We do it as direct market access. So buyers are matched with sellers, and that's the easiest way to understand it. I'm wanting to buy it, so I need to find a seller. Perfect. There are other methods of doing it. I know some brokers will do what's called a B-book model. I think it's a little bit dark and shady. And a B-book is, if you imagine how Ladbrokes or Paddy Power works, you go in, you place a bet. Your bet isn't matched with someone else. It's Paddy Power or Ladbrokes who are taking the other side of that in the anticipation that you'll lose. And across the board, they anticipate that their clients will lose. So then that's another layer. And what will generally happen at these B-book broking firms, they'll split the client book into two segments. They'll have the A book, which are clients who make money. They don't want anything to do with that. They'll actually match that with a seller. That's called toxic flow, and they don't want it. Or the B book, which is a group of people. Or
Oh wow! So they'll match that with a seller.
Yeah,
so
yeah,
not
exactly.
Taking the loss, the loss will be mitigated to someone the risk will be rolled onto somebody else, an external.
Exactly. Precisely. They want nothing to do with that, so they'll actually send that to an exchange as a direct market access, I suppose. And then the B book are people who maybe are persistent losers, and they'll have really intelligent quants who are deriving models to work out which clients make money, which clients lose money. For the clients who lose money, they'll keep that trade in house. And it's just quite shady. So that, if for instance, you buy a stock and it goes down 100%, well, your broker's just made 100%. They haven't made a commission. They will just make 100% of your loss.
They'll take your margin.
Yeah, exactly. Yeah. So there's different ways of doing it, and I've always just preferred transparency, just simple to understand, match buyers with sellers, and it's there's no skullduggery, and it's just I can sit here with go to a family barbecue and be honest about my line of work and my business. It is what it is. Yeah.
Yeah. Well, we were talking before we started the episode. When I met you, one of the first things that hit me about you was just how genuine and how solid you are in terms of ethics,
Yeah.
and that's clearly found its way into what you do into midterm markets as well. Not coming from a financial background myself per se, it was quite refreshing to see that that there is ethics out there, and you're a nice guy as well, Tim. So it is refreshing. But again, I don't come from that world. For those of us who don't come from that world, we have nothing but the films to rely on for information flows about how it is in the city, and I'm sure they're exaggerated, but nevertheless, I don't necessarily believe it's shall we say a world that's
a million miles off. I tell you that.
It's not a world built on, shall we say, strong ethics some of the time. So
it's a pile of crap, if I'm honest with you, at times. So if you've seen the films, don't get me wrong, there are some really good people in the industry, and I've met some great friends and people who I trust wholeheartedly. But in and amongst that is, equal parts shysters and people who will just they don't care. They'll rip off their own granny if it means they can make a pound note. And there is that dark side to the city as well. It's part of the reason why I said Mito Markets. I love stockbroking. I just hate stockbrokers, generally speaking, and I don't like the culture.
Really? Okay.
It's nice to sort of not have to be pegged with that kind of culture, and I can sort of do things on my own terms. I'm, not planning to list and become a multi-billion-dollar company on the Nasdaq. Really, just wanted to do things on my own terms and work for myself.
So, if we talk Mito Markets for a moment, there, then Tim, is your long term, is your future long term in Mito Markets? Do you want to take this?
Yeah.
As far not necessarily scale it, because you just told me that's not why you're doing this. You're doing the driving force is to be your own boss essentially and have control over what you do.
Yeah.
But nevertheless, this is a long term venture for you, I'm assuming.
Yeah. Well, first and foremost, I don't know how to do anything else. This is the only skill set I don't know. And so if I can't do stockbroking, I'd probably have to go back to just a regular job. I don't know what that would be. The scalability, it is scaling on just a sort of a purely organic basis, which I'm really happy about. I don't spend anything on advertising. Every day there's new inquiries, and it starts off slow, then got a bit bigger, then a bit bigger, and now there's sort of I suppose a really nice organic reach whereby lots of people recommend me and Mito Markets, and it's inquiries pretty much every day now. So I'm very fortunate in that sense. And the scalability, I'm happy for it to happen at an organic scale, and keep it sort of as it is, and eventually maybe hire some more people, more support staff, more wealth managers. I'd really like to take on some sort of young folk who are thinking about getting into the industry, but do it the correct way.
Sure. So you train them up.
Yeah, exactly, from scratch. Which would be really nice, and sort of cultivate the next generation of stockbroking talent. That would be lovely.
Yeah, no, with your installed with your ethics.
Yes.
And the ethics of Mito Markets. I like that.
Yeah, precisely.
Going back to the scenario that we were using a moment ago, you were saying that with a direct market access model,
Yes.
with a terminal like like Bloomberg, for example, a Bloomberg terminal, for example, so the framework comes from the exchange itself, and then I'm guessing that the terminal actually just accesses that market or markets or exchanges rather, does it? So,
Exactly.
for example, you've got the LSE, you've got the NYSE. From a technological standpoint, how does that work? Can you elaborate on that for me?
It's not really that. I mean, I can only speak as much as I know because I've never built a trading terminal. But effectively, you pay these exchanges a fee to access their order book and their markets and their liquidity. And you can, build an app. It's not too much different from building an app or just an IT system whereby you've got all the data inputs that you need. You've got the
coming from the exchanges.
Coming from the exchanges, and you can plug it in and you can create a terminal around it. So it's easy, and it's no different from Hargreaves Lansdown, Trading 212, whatever it may be. They've built their own IT infrastructure which has the data points from the exchanges, and they can make their own sort of glossy trading platform around it, which is matching buyers and sellers. So when you are on sort of an everyday trading portal and you're clicking buy, the data, any pricing that you're seeing, that's not Hargreaves Lansdown, that's not Trading 212. Well, I'll leave Trading 212 out as an example because that's a bit different, but say Hargreaves Lansdown or something like that, or Mito Markets.
Yep.
The prices you're seeing is the prices that's been provided by the London Stock Exchange, the Chicago Board of Trade, the Philadelphia, whatever instrument it is, it's coming direct from them, and then the technology around it is just a sort of, that's been built. Yeah, exactly. Yeah.
So it's literally a piece of software that is polling data from a server that's within the various exchanges. So I'm guessing then you can choose what exchanges you want to work with.
Yeah, absolutely.
And when, let's say Mito Market, one day in the not too distant future, goes public and floats on on an exchange,
Yeah.
I have faith, but I don't think it's what you want to do. Perhaps I'm not
It's-
sure. But as the Mito Market's owner, CEO, founder, I guess you can choose what exchange you want to go public with, providing you've got enough capital and you meet the
Yeah.
requirements.
Yeah.
Is that how it works? Do you literally choose an exchange or multiple exchanges?
Yeah, so I think we're connected to literally every major global exchange in the world. There's not many
Mito
assets.
Markets is.
Yeah, there's. I don't. I, you'd have to give me a really obscure stock in Scandinavia for me to say I'm afraid we don't have access to this, and it's very very rare. And then so yes, you can pick and choose which ones. But if you want a properly comprehensive service, I think it is best to be connected to every global major exchange. Because you'll notice sometimes brokers will just be a CFD broker or they'll just be an equities broker. And it reduces
Yeah.
costs, I suppose, ultimately, and it keeps operations more streamlined. And you can be known as just a CFD broker, a bit like CMC Markets or IG, for instance. They have since expanded into sort of traditional, equities as well. But yeah, that's effectively how it works. You can sort of choose to be connected to whichever exchange you want, and we're pretty much connected to everything under the sun, apart from a few obscure ones. Because I'll be paying. We just won't get an order for that particular instrument. There's no point being connected to that exchange.
That was going to be my question. So I'm guessing you just pay these exchanges for access to
Yeah, I mean,
to their systems.
Yeah, precisely. I mean, I pay a third-party vendor, and it goes sort of, so there's three layers. There's midterm markets, third-party vendor who sort of does a sort of an all-in-one 360 type solution, and then they themselves are connected to every major global exchange.
Got you. Okay. Yeah, I can imagine how it works from a technical point of view. Having an engineering background, I can
Yes.
roughly
Yeah.
sort of picture how the architecture behind
Yeah.
it. So with CFDs, for example, is that do all exchanges hold CFDs like a particular CFD?
Depends on the stock. If the stock is popular enough, it will that the exchange will create a CFD market. Because sometimes it's more of a case of, is there going to be enough demand for people to want to trade CFDs in this particular instrument for it to be worthwhile? Because you could come up with sort of an obscure stock that nobody knows about. That stock is going to have trouble generating liquidity of buyers or sellers of just the physical stock, let alone derivatives that come off it. And to give you an example, at the
Got you.
moment,
Okay.
there's a lot of popularity for options contracts on equities, and it's huge in America. You'd struggle to find an American stock which doesn't also have an options market attached to it. However, in the UK, it's not that big of a thing. You can go through the FTSE 250. Not every FTSE 250 company will have an options market because there
An
just
options
isn't the
market
demand.
associated with
Yeah,
it.
yeah. I mean,
And
yeah,
when
you
you
can,
say equities, do you mean stocks?
yeah, exactly. Yeah,
Yeah,
stocks.
yeah, yeah.
So you could find sort of a small cap, stock in the FTSE 250. I mean, to be in the FTSE 250 is already quite big, but if you
Yeah,
open
yeah,
up
yeah.
an options market, you might just find three people want to trade it, and there's just no point, creating a whole options market for it.
And I'm guessing I mean, a CFD is an option, isn't it? Really, it's a form of option.
It's a
It's
contract
a
for
form.
difference, technically speaking. So it's really just it mirrors the share price. One for one. Okay.
It's a derivative.
Yeah, it's a derivative, and it's a God. I mean, my first job was in a CFD brokerage, and this is taking me back. So effectively, you're exchanging a contract for the difference in the share price rather than the shares itself. If that makes
So,
any sense.
it's no, it absolutely does. Yeah. So so an option and a CFD, they're both derivatives, but again, that they're written up differently.
Exactly. Yeah.
They were okay.
The
So
contract for difference is just I'm creating a contract for the difference in the share price. An option is just I want the option to buy this at some point in the next 12 months or 3 months, whatever it may be. So they're slightly different, but they're both derivatives. Yeah.
okay. So with you were saying that let's take let's take something huge. Let's take Microsoft, for example.
Yes.
There's going to be not just one, but there's going to be multiple option markets
Oh,
and
yeah.
CFD markets surrounded
And,
by
yeah.
surrounded by. I'm guessing that's for two reasons. I'm guessing the first reason is there's not enough Microsoft stock to go around. The second reason is perhaps people just want more complicated instruments to be able to trade Microsoft. Is that roughly
Yeah.
right? Is that how?
I've never thought about it from that point of view, in the sense that there's not enough Microsoft stock to go around. Because maybe not, because if there wasn't enough Microsoft stock to go around, then the share price would be double, and that's just how an order book works. It's when the best selling price gets taken out, goes to the higher price, and the higher price, and if there's limited stock, the share price goes up, and that's how
Supply
that
and
works.
demand.
Yes, exactly. Yeah, precisely.
Yeah.
And the more popular the stock, the more speculators there are attached to it, and that's where the need or the demand for contracts around it for people to speculate in more creative ways.
Okay.
And
Rather than just following the share price in real time.
yeah, exactly.
Yeah.
And there's sort of clever things you can do with it. I mean, to give you an example, I was running a demo account for a model portfolio that we were maybe going to do here at Mito Markets. Didn't do it in the end, but I had a lot of exposure to tech stocks, which absolutely had a crap year in 2022. Google, Amazon, Microsoft, they're all just trending down. So I've got this underlying stock in these seemingly underperforming asset prices. Every day I look, they're just going down and down and down. So what I did to slightly sort of generate some income against some losing stocks is I sold call options against my underlying positions. And so what I've done, I've given someone the right to buy my stock off me at a certain higher price, and I charge a fee for that. Now, providing the stock keeps going down, I get to keep that fee. And great, it means I've sort of created
You've hedged.
I've kind of created a synthetic dividend yield against stock, which is just underperforming, because I'm selling the rights away from my stock to anyone who's prepared to buy it at higher prices, but the prices never got there. So I just get to keep those premiums. And the stock just kept going down. While it keeps going down, I'm just sort of collecting these contracts and I'm taking a premium for that, just to generate some income against an otherwise losing stock. And there's other things you could do. I could have bought some put options against it or done all sorts. But yeah, I suppose it's a type of hedge. For me, I just generated a synthetic sort of dividend yield against underperforming stocks, just as a short-term sort of cash generator, if you will.
Would there be a name for that particular type of instrument? Would that be a swap, for example?
I think that's possibly a covered call. It might be known as, yeah.
Okay.
And there are literally hundreds of different strategies with all sorts of silly and creative names. But yeah, there's lots of things you can do. Yeah.
And that again would be provided to you by or the basis of it would be provided to you by the framework of the exchanges.
Yeah,
So
absolutely. Specifically, probably the CBOE, which is the Chicago Board of
the kind
Options.
of Board of Options Exchange.
Yeah, exactly. Yeah, it will either be that or the Philadelphia one. I think I'm not too sure, but yeah, you'll see it when when you're doing these options contracts. You'll have a little code in the order ticket that will say like PHLX for Philadelphia Stock Exchange or CBOE and stuff like that. So yeah, that's exactly how it works.
Amazing. Can we talk leverage a little bit?
Yeah,
So I've got a much better understanding now, thanks to you, of how the world works, of what the world of finance works, I guess.
yeah.
But would you call it the world of finance, by the way? Is that a good term for it? The world of
Yeah, why not? Yeah,
trading, investing, finance.
I know.
Whatever we've been talking about, I've got a better idea of how it works now. But
Yeah,
what always throws me is leverage. Now, I fundamentally understand what leverage is, in as much as you can increase your exposure with essentially
yeah,
borrowed money,
yeah. No
if
different from
you
a
like.
mortgage. Pretty much the same thing as a mortgage. You can't afford to buy £1 million house up front. Not many people have £1 million lying around. So you go to the bank, I'll give you £100,000, give me the other 900. Fingers crossed the house price doesn't go down. But it's no different from doing that with stocks. You're just taking a loan to buy something that you can't afford, basically.
You can't afford. So where does that leverage come from? Is it synthetic, or is it actually coming from liquidity in the exchanges, in the marketplaces? Like, for example, when you say this particular instrument is levered 20 times or 4 times or whatever. Who's dictating that, and where's it coming from?
You're effectively, ultimately, you're borrowing from the bank. Okay, so that would be, I suppose in our case, it might even be JP Morgan or Citigroup, I would imagine. And they're running a loan book. It's no different from running a loan book against mortgages. You can run a loan book against stocks and shares as well. And they've got really, really sort of stringent risk management tools in place so that if there is any hint of volatility, they can sort of close out your position because it's a very, very liquid asset. It's not like a house which can take weeks or months to sell. Some Apple stock can be closed out immediately if you're getting a bit close to your, your initial margin. So effectively, it's no different from a bank's, loan book, and in that sense, very similar, I suppose. Yeah.
Okay, so you'd have a larger financial services firm like JP Morgan or like Morgan Stanley, Goldman Sachs, whatever.
Yeah.
You've got the exchange in the middle of everything,
Yep.
and then you've got you, and with
Yep.
that third party in between you and the exchange,
Yeah.
perhaps, and then you've got me. So it's me, you, third party, exchange, the other side,
People, yeah.
JP Morgan. So
Yeah.
so they're putting the money into the market. Are they directly funding the leverage, or are they just putting investment money into the markets, or is it they're kind of providing that specific leverage for that instrument? I imagine. So an order comes through for this asset class, this CFD, for example, at this leverage.
Yeah.
Morgan Stanley are going to say, like, we'll provide the margin for that.
I suppose you can think of it as, I talked about the third-party vendor who provides the sort of the platform technology and stuff like that. The banks will face them, and they'll have sort of, it's not on a client-by-client basis, they'll just have a whole figure, like a pool of money. And they'll say, right, we've got this much in deposits from clients, which is uninvested cash, or whatever it may be. We've got this pool of money, which is lent out to that person. And the banks will monitor that centralised pool of assets, stocks, shares, contracts, and their job as a third-party vendor is to make sure that book remains in good condition, I suppose you could say. It's not getting sort of too close to the wind. And then that third-party vendor will then, underneath it, monitor all the individual client positions and will act on an individual basis and sort of, you're fine to have leverage, you've got enough money, no, you're sailing too close to the wind, we're going to close out your positions. So it's sort of a three-tier structure, if you will, I suppose.
That would be one level above you.
Yeah, absolutely.
Yeah. So they're kind of, so you're looking after actual retail, let's say retail traders or professional traders, whatever, professional investors, but there are people that there are entities above you, not to use the word above, but
no, they are above you.
But they're kind of trading brokerages, if you will, or looking after institutions like yourself, which are then more responsible. There's like a distribution of responsibility when it comes to leverage and
So the bank faces the third-party vendor faces me and maybe the clients and so forth, and I act as like an intermediary between the clients and the big sort of third-party vendor that provides liquidity and houses all the stock and things of that nature, if you will. So yeah, we're a service provider. We do discretionary management, some advisory, and also just manage the day-to-day relationships of sort of execution-only clients who need to phone up and buy or sell stock or CFDs or options, whatever it may be.
Amazing. Were you expecting the questions to be this technical?
No, they're very technical, but yeah, you're really putting me to the test.
I don't mean to be. I'm just genuinely very, very, very curious about how it works. But a couple of times there, you took a minute to think about it. So either that's a good question, or it's a stupid question, or it's one that requires thought. I don't know, but
it's a really good question. But it's so rare that someone asks about the real, the belly of it, how it all works in its intricacies. And I'm having to sort of remind myself because it's been so long since I've gone. Yes, I've done the exams. I know how it all works, but it's not something I have to talk about for on a day-to-day basis. So
on a day-to-day basis, sure.
My knowledge base as well.
What got me interested in economics and finance? Like I say, my background's in engineering, which I think I mentioned earlier. So the reason why I got into engineering, amongst other things, was because I've always been really interested, really curious about how things work.
Yes.
It doesn't necessarily matter what it is. It could be anything.
Yeah.
I'm a very curious. I consider myself a very curious person, and if it is something I'm interested in, uh, I'll really be curious about it.
Yeah.
So what got me into engineering was that, I was interested in I'm a curious person, and I was interested in technology, because by nature engineering is is working things out.
Yeah. Yeah.
It's manipulating the world around you in some
Quite an
form.
analytical
And
mind then, I suppose.
I guess so. Yeah, yeah. I've got I'm kind of, there's like two parts to me really. I've got a creative mind, but I've also got a very
Mm.
analytical mind as well. So when those two meet, yeah, somehow you end up as an engineer. But yeah, but where I was going with that was, so what? Yeah, I've always been really, in addition to other things, I've always been really interested in finance and economics.
Yeah.
But it wasn't so much. It was never coming from a place of making profit or making money. Although I like to make money,
Yeah.
I'm really interested in how it all works. And
Mm.
that's what, and you can you can fall down the rabbit hole, can't you, with things like this? So I remember probably 5, 10 years ago where I was an engineer and I knew absolutely nothing about finance or economics or the city or anything other than the fact that it existed, but that was it. And you start by, you come up with a question. You start by, you go on a YouTube or a Google
Yeah.
binge, and you answer one question, and then with that question, two more questions come
Yes.
about, and you answer those questions, and before you know it, I'm here talking to you today, and I've got I some. I mean, in addition, of course, it's also an aid of what I do. It's
Yes.
particularly now that I'm running my own business, but yeah, no, I'm really fascinated and really curious about how it all works. So
Yeah.
that's where all my technical questions
Yeah.
are coming from. It's not I'm not trying to trip you up with any of them at all. It's all coming from a place of curiosity.
Well, it's nice for me to sort of dust off the old cobwebs and sort of actually have a think about, well, hold on a minute, how does it all work?
Yeah.
But yeah, really good questions. Yeah, absolutely.
So, putting it back then, Tim, to what I do.
Yeah.
These days I'm now pursuing a different career, if you will.
Yeah.
I'm much more in real. I've left engineering behind, and I'm in real
Yeah.
estate now, which has been my my family business for as long as I can remember. So
Mm.
I'm doing a combination of things. I'm working with a family business, but I've also created my own business where
Mm.
it's all real estate based.
Yeah.
So this is my interest and what we're doing right now
Mm.
in talking about finances in relation to that. It all stems back to that. But in terms of assets that I trade, it's more often than not REITs,
Yes. Yeah.
which
Yeah.
yeah, a long way around a very short point there. The asset class that interests me the most is REITs, because REIT being a real estate investment trust, it's another
Yes.
derivative. Well, it's not. But yeah, it's no, REITs would actually be a particular stock type, wouldn't they? I suppose
Yeah.
it's not.
It's
Yeah,
I suppose it's a type of investment trust. If I'm not mistaken, just a pooled investment, which sort of works by certain rules, and it
yes,
just they invest into a collection of properties, and then they distribute 90% of the income generated of those properties through the real estate investment trust. And yeah, you can get these listed on the FTSE 250, FTSE All Share, some very big ones. Yeah, and it normally have quite a sort of semi-healthy or sometimes a really healthy dividend yield attached to it, because it's just pumping out any income back to the shareholders. Well, not any income, but 90% of it, which is,
profit,
yeah, yeah, exactly, yeah, precisely.
and you get the capital growth as well of the stock.
Exactly, yeah. If their sort of portfolio, goes up in value, which fingers crossed it does, and it's funny because I I don't have much experience with real estate other than owning my little flat that I live in. But as a general, I suppose I like the idea there's
Other than owning my little flat that I live in. So yeah,
limited to one property, yeah. But it's nice that there's finite land, but there's infinite people, and you'd think that property as a commodity can only go one way. I mean, doesn't guarantee it, but it's nice to have that as a base of any investment.
It's really interesting that you say that. Land is finite,
Mm.
but what were the words you used? Land is finite, but people are infinite, or in comparison.
We
Yeah,
produce, yeah, and populations keep growing, and then in theory that you've got that perfect supply demand, which anyone who owns that commodity, that finite commodity of property, you'd think over the very long term it should only go one way. But yeah, just
it's a
my thoughts.
monopoly.
Yeah, yeah, a
Yeah.
little bit, yeah,
But that is the very definition of economics, isn't it?
yeah,
If
yeah,
in the Garden of Eden, for example, where everything is where there's a plentiful supply of everything, there's no need to economize because
yeah,
there's a plentiful supply of everything. When you need to, like for example, beachfront property, there's only so
yeah,
much
yeah,
beachfront, and everybody wants to have beachfront property. So you know there's an economy there, and with like you say, with prices that in theory should only go one direction, but
yeah.
with with REITs, for example, it's actually quite interesting. I bought a REIT recently, which
Mm.
was the corporation's called the American Tower
Oh right,
Corporation. I don't know if you're familiar with it.
can't say I've heard of it. What's the American Tower Corporation?
Let me find it. Yeah, it's that's
And is
just it,
this?
American Tower Corporation. So it's a company that's structured as a REIT,
Mm.
and what they do is this is why I love real estate. One of my my biggest passion. I love land and
Yes.
its many alternative uses.
Yeah. Yeah.
Some people see a field. I see a field, but I also see what it could be. So
Yeah.
real estate is not just houses or commercial buildings. So what American Tower Corporation do is they buy land and install radio antennas.
Oh really? Yeah. And they
Yeah, they
found
do.
maximise the sort of commercial purpose of that land.
Correct. Yeah, yeah. They buy a small plot of land. They get permission to put a tower up there, and then they
Yeah.
rent tower space out to the various telcos or whatever. So Vodafone, EE, or whoever. They're just
Yeah.
people just come along and stick
Yeah.
their dish on
Yeah.
that tower,
Sure.
and they charge out rent and they charge rent
Yeah.
out they charge a rental fee for that. So yeah, that's I came across them recently and did some research on the company and I have bought I have invested in them, but
I-
I love that's a REIT. My point is
Yeah.
that's
Yeah.
structured as a
Very
REIT. They
cool.
technically own real estate, even though they're a
Yeah.
telco company on face
Yeah.
value.
It's amazing.
So
You've got
yeah,
that
it really is.
flows from the rentals coming through every quarter, every month, the appreciation of the land potentially as well. It's maybe not hugely capital intensive if it's just a tower. It's not like building sort of the Shard or something like that. It's not too expensive to put together potentially versus other projects. So yeah, it does sound very interesting.
Yeah, you buy the land or secure the rights to use the land. I think the hardest part there would be planning permission.
Yeah,
That would be the
yeah,
most expensive and the most difficult bit. But you buy an off-the-shelf tower, and it
mm,
comes and gets installed in a day. You put a little concrete pad down. You probably have to get comms and electricity to it. But
yeah,
so whenever I walk the streets now and I see buildings with antennas on the roof, I'm
yeah,
thinking like an apartment block with antennas on the roof. I'm thinking they've got people rent, but they've also got antenna rent. So it's
yeah,
amazing how I love how there's an infinite amount of ways you can make money
yeah,
in
yeah,
this world,
yeah,
in particular with real estate as well. But so if I came to you scenario, Tim, if I came to you and
yeah,
said I wanted to invest in um, the American Tower Corporation, for example, or
mm,
with the way global demographics are at the moment, I wanted to invest in retirement-based REITs, so retirement housing-based REITs.
mm,
Um,
mm,
is that something that Mito Markets could help me with? Could you
yeah.
facilitate?
Certainly. If it's listed, we'll have it. Yeah, completely. It's very rare I come across something that we're not able to trade or facilitate. Um, so yeah, and if we can't do it on our main platform, I can sort of look at other solutions and find liquidity elsewhere potentially. So yeah, anything you need, if you just give me a general investment theme, I'm happy to sort of have a look and come back with some ideas and some suggestions as well. Because I suppose we're light touch advisory. I'm not going to come on the phone and explicitly recommend stocks and shares for you to buy. If you're a little bit unsure and you're unstuck and you go, and you know what the general theme is, I'm happy to do a little dig and come back with some ideas, and you make the sort of decision yourself. And it's just very light touch, very passive, because we're very cheap, so it's not commercially viable for me to sort of spend all day giving explicit advice, but it's just a nice way to add on a bit of service. So yes, if we can't find it, I'll find an alternative which might be suited.
So if I came to you and said, Tim, I want to invest in retirement homes in Germany, for example, is that
Yeah,
specific enough for you to go off and find REITs, I guess, or stocks, or
I mean, that's incredibly specific. Yeah.
yeah,
So if it's retirement homes in Germany, I might even struggle to find something listed, but I'll do my very best, something sort of European based. But to give you an example, I had a lady come on the phone the other day. She goes, "Oh, Tim, just buy me 10 grand's worth of gold," and that's a very broad based question because, well, do you want a gold ETF? Do you want a gold miner? Um, do you want a gold
a
future?
gold miner, as in a gold mine.
Yes, exactly. Yeah. Do you want like Rio Tinto? Do you want Glencore? All these kind of mining stocks that are correlated to the price of gold. So it's that kind of, she knows what she wants to invest in. She just needed a bit of hand holding, and then eventually sort of, I think we walked towards sort of a gold ETF where she just wants to correlate the price of gold, and I talked her through sort of a low cost tracker fund. So yeah, it's that sort of light touch, generalized advice if it's needed.
Amazing, amazing. Tim, this has been so fun and informative for me. I guess if we start to wrap this up,
Yeah.
I'd like to kind of close this down with this, or wrap this up with this question. So, whenever you go on platforms today, like including yours, I'm guessing it's a legal obligation. I mean, you started the call with this. I don't know what the percentage is now, but it's a high percentage of people who get into investing, get into trading, actually lose their money. Sadly, is it like 75% now, or?
On leverage, so on just non-leveraged, you buy stock, sell stock, whatever. I don't actually have the stats as to who wins or loses, if I'm being completely honest.
Yeah.
On CFDs specifically, which is a leveraged instrument where you are borrowing money to buy something, unfortunately, yes, something in the region of 60 to 80% of people will lose money. And sometimes that can be a strategy whereby, it's a leveraged trade. And you may have 3 or 4 losses, have very tight stop losses, and then let your winner run. So overall you make more profit. But then there's a lot of people where it kind of feeds into that gambling mentality. Something that I sometimes get pushed on is, investing, isn't it just gambling? I tell you now, if you want it to be gambling, it can be gambling. And if you're sort of chasing losses and chasing, getting yourself into a downward spiral when you've made a few losses, you can turn it into basically a Labrix account pretty quickly if you wanted to, because you're borrowing money on something that you can't buy and you're speculating. And if you don't have much of a strategy going on, you're just sort of spray gun approach, then yeah, it can be pretty devastating. You can lose money quickly. So if you've never traded on leverage, don't. It's my first shout. Don't do it. There's nothing wrong with just long-term buy and hold, boring style investing, sort of Warren Buffett style. I don't even day trade, and I've been doing this for sort of 10, 12 years. I prefer just long-term buying and holding, but each their own. So yes, to answer your question, if you are trading on leverage, the majority of people do tend to lose money in the retail space.
And the question was going to be, why do you think that is? Is it the leverage? It's got to be the leverage that wipes people out. Now, some of these instruments are 20x levered, and it's just the small. And I don't think people understand that. What even that it's levered, number one, two, what leverage even means.
Yeah,
the smallest move will just wipe you out.
Exactly. And thankfully the FCA have come down on this a lot. So when I first started, used to get a lot more leverage. So 20 times leverage is still available on FX pairs because you have much smaller moves, generally speaking. On FTSE 100 stocks, you used to be able to get 20 to 30 times leverage. So if you put down £1, you can get 30 quid's worth of stock. If you put down £1,000, you can get 30 grand's worth of stock. You get the idea. Now it's more like 3 to 5 times leverage. So if you put down £1,000, our system probably isn't going to give you much more exposure than £4,000 to £5,000 maximum. And that's if you meet certain conditions, and the stock isn't about to report earnings. The stock isn't that volatile. You don't have concentration risk like your whole portfolio is riding on one stock. So that's really good from the regulator that they've kind of cracked down on this and sort of just restricted the leverage, full stop. So it's getting better. But yes, leverage is still available if you want it. I wouldn't recommend it if you're a novice. If you really want to experience it, there's nothing wrong with just doing a demo account. Fake money. You can't do any damage there, but you get to sort of get an idea of what it's about, the mechanism. You can
And how
experience
quickly you can get wiped down.
Yeah, and yeah, at times it can go in your favour, and you can make a fortune in a small period of time. And the worst thing that can happen, you start to think you're an investing genius because you've had a couple of wins under your belt, and you get overly confident. You're not managing the risk, and actually can be more damaging than good when you have this confirmation bias. Everyone has confirmation bias, and sometimes when you're trading on leverage, you'll fall into more technical analysis, and that can sort of lead itself to more confirmation bias because you can find a chart pattern for anything you want if you really look for it. But yeah, just my thoughts on if you really want to do leverage, do it on a demo account, and if you're comfortable, go to a live account. But generally speaking, I wouldn't recommend it full stop unless you really know what you're doing.
Yeah. And it's interesting that it goes back to a question that I forgot to ask you earlier with leverage. If I wanted to, let's say, go long the S&P and I wanted to short the DAX, the DAX is the German
Yes, yeah.
index, isn't it? If I wanted to short the DAX and go long the S&P, could I do? And I asked you, this is what I want to do, Tim, but I want to go on leverage. Do you dictate to me, or is someone dictating to you exactly how much? Do I have the option to do 4 times rather than 20 times, for example? Is there an instrument out there that will allow me to do that? Because I want to control my leverage.
Of course. So the leverage would be the maximum leverage is afforded to you. Whether you choose to gear up to the most that you're allowed to have is entirely up to you. You don't have to. So let's say an S&P tracker would give you 5 times leverage. So you put down £1,000, you can get up to £5,000 worth of gross exposure to that index tracker. You don't have to have £5,000 worth of gross exposure. If you've got £1,000 in your account, you can just do 2 times or 3 times if you want. You don't have to. It's entirely up to you how much of it you want to utilise.
And Mito can set all that up for you. So I can, use your platform or call you and say I want to be 2 times leverage the S&P, for example. I want to put £1,000 on the S&P index and leverage up 2 times if I'm allowed to do that, of course.
Yeah, we don't have strict rules. It would just be a conversation of your position size would dictate that you're 2 times leverage here. If you want 2 times leverage, then don't do any more than 2 times leverage. Just take a smaller position size. It's just a simple question of how many contracts you buy, and you'll see it on the system. You'll see, you're using up this much margin, which means you're this much leverage, and you can reduce the size, and it can work like that. Yeah.
Can you reduce the size in the live contract? So, for example, if I've got if I'm long the S&P, I've got a live position and it's 2 times leverage, then I want to expose that to 3 times leverage. Is that a new position, or can I actually, in real time, live, change the leverage of a live asset?
You would just add to the position. You would just buy more of it. That's all you would do. And if it's still within the parameters of the leverage you're allowed, it would just mean you're increasing your gross exposure. We still have that deposit from you held on account of, say, £1,000, and instead of having 3,000 of exposure, you add another few more contracts, and you've now got 5,000 of exposure.
But with the initial margin, is that margin with the initial investment of 1,000? I've got you.
So you've got that money just earmarked to the side, if that makes sense.
It does now.
It's very different from going to the bank and saying you've got £100,000 to buy a house, or you've got a deposit. The bank would say, well, we're prepared to lend you another 900,000. So your total exposure is £1 million. You don't have to buy £1 million property. You can just buy a £500,000 property with your £100,000 deposit. So it works more in that sense, if that makes sense.
No, it really does. That's actually a really good analogy. Your deposit, that is called the margin, right?
Yes, exactly. Yeah.
That was a simple little element to it there that I always got confused with the margin versus the. But Tim, to truly round it off then, it's if you had to, if I was a novice and I wanted to get into investing, I wanted to get into trading.
Yes.
I'm a white sheet of paper. I've not done it before. What would your advice be to me? What would your words of caution be to me? What would your what would your pearls of wisdom be to someone like myself? I say if I was a novice, I am a novice, I guess.
Yeah.
But Tim, what would you say to me?
I think first and foremost, it is so easy to get caught up in sort of chasing pots of gold. And any time you go online, you're going to see sort of fantastical stories about people making X amounts of money through individual stocks, crypto, potentially quite high risk asset classes. And I think there's absolutely nothing wrong with just taking a very slow and steady approach to it and just buying an index tracker to start out with. It gives you exposure to a broad-based basket of companies, and that could be the S&P 500, the 500 largest companies in America, or something else that may take your fancy. And you're not having to take on individual stock-based risk. And for instance, Tesla. That's a really good example where people talk about it endlessly on Twitter, YouTube, social media, and you've got these bulls and you've got these bears, some saying it's going to go to the moon, some say it's going to crash. Just remove yourself from the situation. You don't have to buy Tesla stock. There's nothing wrong with just buying an index tracker where you just have a basket of global equities that includes Tesla and Apple and Microsoft and Adobe and some of the pharmaceutical companies, some of the banks. So you're not exposed to this sort of massive swings in individual success stories. So I've always said just take a passive approach. If you feel comfortable with that, and after a few years, and you feel like you're building up your knowledge base, or sometimes people will just enjoy investing in a story. Apple is a really popular one because everyone has an Apple product. I've got the phone, I've got the headphones, I use their iPad, I've got their earphones. I'd like to buy some Apple stock, and I can understand the thesis behind that. So yeah, once you've sort of built up some knowledge and you feel like you've got a good understanding, then maybe start to dabble in a few individual stocks if you're happy with the risk. But yeah, index trackers to begin with. Yeah, nothing wrong with that.
Control the leverage, and as you said, non-participation is always an option.
Yeah, absolutely. Yeah, precisely. Yeah. So those are my pearls of wisdom for now. Anyway, not very exciting.
No, very exciting, and very incredible pearls of wisdom there. Wise words from Tim Sunderland of Mito Markets. Tim, thanks so much for coming on. I do hope you've enjoyed yourself. I know I certainly have, and I feel a lot wiser after this call. I really do. One of the many reasons why I do this is to learn. We've spoken quite a little bit about that, in this call. So thank you for coming on. I do hope that you'll come on again as I grow this.
Absolutely.
And
Anything.
thank you. I appreciate that. It's really nice of you. But I guess we'll wrap it up. I'll say again, thank you, Tim, for coming on. We'll hopefully see you again, and everybody who's watching, will thank you for watching. And until next time, I'll say goodbye for now.
Awesome. All the best. Cheers.